Welcome back. Well, let's get to our next guest. We have Mr. Gopal Agrawal, the Chief Executive Officer at Anupam Rasayan India, who joins us on the show. Hi, Mr. Agrawal. Thanks a lot for joining in, sir. Just coming to you. But we've got three big talking points that we want to discuss with Mr. Agrawal. One is the export market outlook. Second, the working capital improvement. And third, the commercials of various contracts as well is what we are looking at. So let's get straight to the point then. Mr. Agrawal, thanks a lot for coming on the show. Well, exports are approximately 58% of your order book, right?
Yeah.
A lot of it is coming in from the United States as well. Could you tell us first, what does this 50% tariff mean for you? And what are your customers, your clients telling you, post this imposition of these tariffs? Please go ahead.
So first of all, let me clarify, currently, I would say almost 60% of our export is to Europe. Another, I would say 20-25% is Japan. And as far as US is concerned, it was roughly, I would say, more like 2-3% of our revenue, which is likely to grow to, let's say, 10% of the revenue this year. So from that perspective, it's not that US was a significant part of our exports. Having said that, honestly, we are not seeing, let's say, much of a challenge. As far as the customers are concerned, they have continued, to ask us to kind of build on, let's say, the production. We have not heard from them, any kind of a disruption as such. Wherein they are wanting us to kind of let's say slow down the production or anything of that sort. That's number one. Two, as I said, for us the exports is across Europe as well as Japan, and on those geographies, leaving let's say US for a moment out, is growing significantly for the kind of contracts we have signed. Currently, let's say for example, my Japan revenue is roughly around 16-18%. With the contract in place, in 2 to 3 years, my Japan revenue could be easily 1/3 of my overall revenue. So from that perspective, we are pretty well diversified as far as our exports are concerned. So yes, would there be kind of let's say some short-term impact of the tariff? The answer is yes, but I don't really see that should really impact not only us, but any of the chemical guys in the long run.
That's good clarification. So currently, US is extremely small, 2 to 3%, but you're saying that it could go to double digits. By when does that happen?
By the year end.
By the year end. All right. Got it. Let's move on then. Your order book, I think if I got that number correct, is around 14,600 crores. You have around 15 orders, out of which 11 are still letter of intents. Could you tell us when do these become final agreements? When do these contracts get commercialized? Some broad idea in terms of margins?
So thanks for asking this question. See, in our case, letter of intent is as good as a contract. The way it works is that before we get into signing a letter of intent, it's an effort of anywhere between 2 to 5 years, wherein the product goes through all the, what would you call, certification. Let's say in case of agro registration, in different geographies, it passes through, let's say commercial test, pilot test, and all of that. So LOI for us, it's more of a nomenclature, which is just kind of, let's say, at the fake end of a contract. And in fact, in some cases, we even start supplying commercially, on the basis of LOI itself. Number two, all of these LOI, given most of our customers are MNCs, it does require a board approval from their perspective. So, for all practical purposes, I would say these LOIs are as good as contract.
Can you give us some idea about your working capital? Because you have indicated that there's been a big increase in working capital. So from how many days to how many days? How long do you expect this to last? And what are the options available to try and kind of limit the impact?
So, I would say maybe a bit of a longer answer to this. Given the kind of a business we are into it, we are largely a B2B player, working with, I would say, the top-notch MNCs. And our contracts are basically long-term, which run anywhere between minimum of 5 to 7 years. Of course, we have had, situation where, some of our customers and product contracts have been running for maybe about 20 years or 30 years. So that's kind of one part of it. Given in most of our, let's say, contracts, we are either the primary or the exclusive supplier to our customer. So, while I may be supplying, let's say, a material or a molecule worth $10 to $20 million, to my customer, but his end molecule is maybe worth $1 billion. So from that perspective, I become pretty, let's say, important, to ensure that the supply chain is kind of taken care, without which, his end molecule could be a bit of a challenge. and which is where, as part of the contract, we are expected to maintain anywhere between, let's say, a overall inventory of 5 to 6 months, given the criticality of the product. And, we need to have certain amount of stuff at our plant, certain at Indian ports, certain at foreign ports. So from that perspective, I would say for the kind of business we are into it, and given the kind of EBITDA margin, of anywhere between 24 to 26%, which we enjoy, we do have, let's say, a working capital cycle, which is 6 months. Having said that,
6 months.
Yeah, having said that, there were definitely a bit of I would say, headwinds, across globally, for the chemical companies and agrochemical in particular, in last, I would say, 6 to 7 quarters. So to that extent, one has definitely seen a much higher working capital kind of accumulating, for us. But if you would see, my Q1 numbers, very clearly, you have seen a significant jump in our revenue. I mean, our quarter, year-on-year revenue, my Q1 FY25 revenue grew almost 100% compared to the last year.
Absolutely. Absolutely. No, Mr. Agrawal, I understand it's the nature of your business. We're just trying to get an idea about the number. I'll come to the growth as well.
Yeah.
So just quantify this, given everything that's happening and the tariffs for now, they're here. But what is the visibility? How much will you grow your top line by this year? Can you retain margins at around 26%? And what will be the number of working capital days?
So as far as the growth is concerned, again, I think if you take out those 2 years, we as a company have grown at 25 to 30% CAGR, and we will continue to grow at that or even higher, given the kind of a contracts which we have signed, let's say, over last 2 years. That's number one. Two, as far as the margins are concerned, most of our contract, would have margin anywhere between that 22 to 26%. So from that perspective, I think we will maintain our EBITDA margin even going forward. As far as
you will maintain the margin, correct? And the revenue you said for this year?
For this year, as I said, I can't kind of guide you, but you have the Q1 number. If that is any indication, I can tell you. As I said, we are more than going to come back, to the glory days for sure.
All right. What about pharma revenues? They used to be at, I think, around 25 crores, or that scaled to around 75 crores. Could you tell us, is this LOI based, non-LOI based, and where do you see this number headed?
So pharma, our strategy, is very clear where, we are making what we call as KSM, key starting material. And this is basically an import substitute. And as far as the percentage is concerned, this year, my pharma revenue would be 20% of my overall revenue. So pharma has grown, I would say, very significantly for us compared to maybe, let's say, 4-5%. It's almost going to be 20% this year. And we do see, this number growing, let's say, both in terms of absolute and even in terms of percentage. So pharma has been definitely, I would say, one of the what you call good kicker, in terms of the growth for the current year as well as going forward.
Okay.
Yeah.
Yeah, Gopal, back to glory days. Look forward to it and look forward to our next conversation. Thank you very much. Good luck as you execute.